Today, we're uncovering why Visa isn't just another payment processor. It's the digital gold standard of the modern financial system. While most investors see Visa as a mature company in a boring industry, the reality is far from exciting. Visa is quietly capturing a 200 trillion ocean of new payment flows that never used credits before. From gig economy payouts to cross-border B2B, better known as business-to-business transactions. What makes Visa truly special isn't just its 665 billion market cap or its impressive growing EPS this quarter. It's how they're achieving these results with surgical precision. The magic happens in the details. While the world shifts from cash to digital, leaving 11 trillion still in cash to checks to capture, Visa isn't chasing shiny objects. They're leveraging their existing network to dominate new payment territories. Their value added services grew 26% to 2.3 billion this quarter. Across border volume surged 16%, and their Visa Direct platform has become the hidden gem powering money movement from Venmo, PayPal, and even crypto platforms. This isn't about predicting the future of payments. It's about recognizing that Visa is already building it, one transaction at a time. And the best part, they're doing it without needing to reinvest themselves. Today, we'll show you why Visa represents one of the clearest example of sustainable compound growth in the entire market, and exactly when it makes sense to buy. Visa's business model creates incredible network effects where more users attract more merchants, which in turn attracts even more users. This virtuous cycle has allowed Visa to consistently deliver double-digit revenue and earnings growth even through economic downturns. The company has built what Warren Buffett would call a wide moat around its business, making it extremely difficult for competitors to challenge their position in global market payments ecosystem. Let's look at Visa's operation and how they make money. Visa's network is called an open loop network, meaning the company that issues your credit, like Chase or Bank of America, is separate from the company that processes merchant transactions. Visa functions as the connective tissue in a four-party model. You, the consumer, your bank, the issuer, the merchant you're buying from, and the merchant's bank, the acquirer. When you swipe your Visa card at a store, Visa's technology processes that transaction, verifies funds, and facilitates the transaction of money all in seconds. Think of Visa as a highway system for money. They don't own the car, they don't manufacture the vehicles, but they build and maintain the infrastructure that allows money to move efficiently between parties. This elegant business model generates revenue through small fees on each transaction while bearing minimal credit risk. Brilliant setup that we'll explore even more. What makes Visa truly special is its incredibly wide economic moat, those sustainable competitive advantages that protects its business from competitors. First, Visa has built one of the most sophisticated global payment network infrastructures in the world, processing transactions with remarkable speed and reliability. Their systems handle an astonishing volume. We're talking about facilitating approximately $14 trillion in payments annually across more than 200 countries and territories. Second, Visa's fraud detection capabilities are industry leading. They use advanced AI and machine learning to identify suspicious transactions in real time, which builds tremendous trust with both consumers and merchants. This is crucial because if people don't trust their payments are secure, they wouldn't use the network. Most importantly, Visa's benefits from powerful network effects. The more people use Visa cards, the more valuable the network becomes for merchants, which encourages more merchants to accept Visa, which attracts more cardholders. This creates what economists call a two-sided marketplace that becomes increasingly difficult to displace over time. Unlike many technology companies that require consistent innovation to stay relevant, Visa's moat actually widens as more participants join its ecosystem. This is why Visa has been able to maintain its dominant position for decades while consistently increasing its rate on transactions. Now that we understand how Visa works, let's examine their recent financial performance. Visa reported their quarter three earning recently. They reported 10.2 billion in net revenues, which was 14% year over year and surpassed analyst expectations of 9.85 billion. Even more impressive was the earnings per share performance, $2.98 on a non-GAAP basis, which represent 23% growth compared to last year and beat estimates of 2.85 cents. This earnings beat wasn't a fluke. Visa has consistently exceeded expectations for years, demonstrating the reliability of their business model. During the earnings call, their CFO, Christopher, highlighted that their value-added services segment grew an impressive 26% year over year. These services include things like advanced data analytics, fraud protection, and other premium offerings that generates higher margin revenue beyond basic transaction processing. Cash flow tells equally compelling story. Visa generated 6.73 billion in operating cash flow, up 31% year over year, which after 421 million in capital expenditures resulted in 6.3 billion of free cash flow, which is quite impressive. This exceptional cash generation is what allows Visa to consistently return enormous amount of capital to shareholders, which we'll explore in the next slide. So Visa's financial strength really shines when we look at their cash flow and how they allocate capital. This quarter, they generated 6.3 billion in free cash flow, representing a 33% year-over-year increase. What's remarkable is that Visa returns nearly all of their free cash flow directly to shareholders. In the most recent quarter alone, Visa returned a staggering 5 billion to shareholders, 1.15 billion in dividends, and 4.83 billion through share repurchases. That's right. In these 3 months, Visa bought back nearly 5 billion worth of its own stock. For dividend investors, Visa has been consistently growing their dividend for decades, making it a reliable income source that also benefits from share price appreciation. But what really excited me is in their share repurchase program. With almost 30 billion still authorized for future buybacks, Visa has tremendous flexibility to continue reducing shares outstanding, which directly boosts earnings per share growth. This capital allocation strategy is textbook perfect for a company like Visa. When your business generates such reliable, high margin cash flow and your stock is reasonably valued, buying back shares is often the highest return use of capital. It's one reason why Visa has such phenomenal long-term compounder. They consistently deploy capital in ways that maximize shareholder value. Behind Visa's financial results are more incredibly strong growth metrics that tells us what's really driving the business forward. Let's break down their key volume metrics that power Visa's revenue engine. Total credits in Visa's network grew 7% year over year, with credit cards increasing 8% and debit card rising 6%. The card growth translates directly into more transaction volume. Visa processed 10% more transaction compared to the previous year. Perhaps more importantly, cross-border volume, which carries higher margin growth, grew an impressive 16% year over year, or 12% on a constant currency basis. This international expansion is crucial for Visa growth story as they continue to penetrate emerging markets. Payments volume grew overall 8% year over year, with an interesting trend emerging. Debit transactions are growing faster than credit. This makes sense in today's economic environment, where consumers might be more cautious with spending, but it's worth watching to see if it becomes a long-term trend. The beauty of Visa's business is that these volume metrics compound in a virtuous cycle. More cards leads to more transactions, which attracts more merchants, which encourages more consumers to get Visa cards, and so on. Each percent point of growth in these metrics directly translates to revenue and profit growth with minimal additional investment. That's the power of their asset-light network-based business model. Let's explore Visa's first major growth driver, the global shift from cash to digital payments. This isn't just a trend, it's a fundamental transformation of how the world moves money. Right now, more than 11 trillion in consumer spending still happens in cash or checks. That's roughly equivalent to Visa's entire current consumer payment business. What facilitating is that this isn't about developing countries catching up. Even in advanced economies like Japan and Germany, places you'd expect to be fully digital, they're still relying heavily on cash. From my personal experience, last time I've been to Japan, a lot of stores were accepting cash. And this was a very much of a shock for me as well for first time going to for them to accept cash majority of the time. A lot of the places wouldn't even take credit cards. So yeah, in Japan, cash accounts for over 50% of transactions, while Germany has one of the highest cash usage rates in Western Europe. This creates what I call a multi-decade runway for Visa's core business. As these behaviors gradually shift towards digital payments, Visa stands ready to capture that growth without needing to change its fundamental business model. They're already built the global infrastructure, established trust with merchants, and created a seamless experience for consumers. The beauty of this transaction is that it's happening naturally as younger tech-native generation replace older demographics. Smartphones become more ubiquitous and government push for more transparent financial systems. Visa doesn't need to invest anything new. They simply need to be present as this massive behavioral shift unfolds across the globe. Our third and fourth growth drivers are closely related: value-added services and cross-border expansion. Let's start with software like tools Visa is layering on top of its network. Things like advanced fraud prevention, tokenization services, consulting, and data analytics. What's brilliant about this segment is that it's not only generate additional revenue, but also makes the entire Visa platform stickier and more valuable to partners. In 2024 alone, this segment generated nearly 9 billion in revenue, growing at an impressive 18% year over year, actually outpacing their core transaction business. These services create what economists call switching costs. Once a bank or a merchant integrates Visa's fraud detection or analyst tools, it becomes increasingly difficult and costly to switch to a competitor. Then there's cross-border transactions, which now accounts for 50.5% of Visa's total payment volume. These international transactions carry higher margin foreign exchange fees, making them particularly valuable. As more people travel, shopping online internationally, and work remotely across borders, Visa is perfectly positioned to capture this high margin segment. Looking ahead, Visa is predicting a seamless, secure, and interconnected payment landscape in 2025, driven by technological advancements and involving consumer behaviors that play directly to their strength. The company is positioned to benefit from multiple growth levers simultaneously. Global personal consumption expenditures growing at about 5% annually, cash to digital migration adding another 3 to 5% annual growth, and their strategic expansion into new payments flows. Analysts are forecasting double-digit revenue growth for Visa in 2025 and 2026, with 13% EPS growing in both years, which is remarkable for a company of this size. What's particularly impressive is that their growth rate doesn't even fully account for potential boosts from their aggressive share buybacks, possible pricing power, or further margin expansion. No investment in is without risks, and Visa certainly has some challenges to navigate. Let's examine the headwinds facing the one of the emerging risks is the risk of stablecoins and cryptocurrencies. While Visa is experimenting with digital assets, it's unclear whether the innovations would enhance or erode its competitive advantage over time. Stablecoins potentially eliminate the intermediary in payments, which is essentially Visa's entire business model. We also saw this for the operating expenses grew 21%, primarily due to litigation provision, which raised questions about whether Visa can continue to leverage its operating model efficiently. While management calls this one-time effect, it's worth monitoring how operating expenses grew relative to revenue. Finally, as a global payments company, Visa faces regulatory pressures in virtually every market they operate in. Any significant regulatory challenges that limit their ability to change transactions transaction fees could sustainably impact their business model. To put Visa's valuation in context, let's compare it to its closest competitors, MasterCard and American Express. Visa has the largest market capitalization at $665 billion, followed by MasterCard at $475 billion and American Express's $150 billion. Their size difference reflects Visa's dominant position in the global payment ecosystem. In terms of valuation, MasterCard actually trends at a higher forward PE ratio of 35 compared to Visa's 31, making MasterCard 13.3% more expensive than Visa. American Express trades at a more reasonable 25 forward PE. When we look at historical growth, MasterCard has grown revenue at 11.3% over the last 5 years, significantly ahead of Visa's 9.5% growth rate. However, it's important to understand that these companies have different business models. Visa and MasterCard operate open loop networks where the card issuers and merchant processors are separate entities, while American Express operates a closed-loop network where they handle both the sides of the transactions. This structural differences makes American Express bear more credit risks, but also captures more of transaction value, while Visa and MasterCard has more asset-light, fee-based models with less risk, but all potentially lower margins per transaction. This structural difference makes American Express bear more credit risk, but also captures more of the transaction value, while Visa and MasterCard have more asset-light, fee-based models with less risk, but also potentially lower margins per transaction. The key takeaway is that Visa sits between its two main competitors in terms of valuation, not as expensive as MasterCard, but not as reasonably valued as American Express. Given their growth trajectory and market position, this seems appropriate, but leaves more room for errors in execution. Now, for the crucial question, is Visa fairly valued at current prices? To answer this properly, I believe we should look at some of the key financial metrics. All right, so let's look at Visa's financials. So first one on the list is revenue. So if we're looking at overall revenue and annually, they're, as you can see from the trend line, they're growing at an impressive rate. Visa is growing at a 14% revenue growth, which beats the market's 5 to 7% average, showing a strong business momentum. It's really important to look at their revenue, and which is quite impressive. And another thing I believe we should be looking at is earnings per share. So, which is even better because their 23% EPS growth significantly outpaces revenue, proving operating leverage is working. This efficiency creates the compounding effect that we want to see. More importantly, the value-added services grew 26%, showing Visa's strategic shift to higher margin revenue streams. This isn't just growth, it's higher quality growth that sustains Visa's exceptional profitability long term. Other things that we should be looking at is within cash flow. So one of them is their operating cash flow. As we can see, the cash flow is growing 31% faster than revenue. That's what we call improving cash conversion, and it's a huge positive. Many companies report good earnings but struggle to turn these into actual cash. Visa does the opposite. Their business model is exceptionally efficient at converting revenue into cash. So after taking out the small slice from the capital expenditures, we get free cash flow, which is another important metric to look at. So as you can see, their cash flow for this quarter was $6.31 billion. That's a 33% growth. This number is crucial for valuation because it represents the cash Visa can actually use to grow the business or return to shareholders. Now we should look at where some of that cash went, and some of that cash gets also converted into dividend. So there are many ways that free cash flow is used. One of them is dividend, and so almost it went entirely back to owners through buybacks and dividends. That's $4.83 billion in share repurchases, which is massive. Actually, let me show you some of these, which is another important one to look at, is shares outstanding. As you can see, their shares outstanding have been significantly decreasing, and that's another way of using their free cash flow is buybacks or dividends. And you can see that they have been purchasing it at an impressive rate, with this trend line. So back to our cash flow, and as you can see, their dividend paid out to shareholders have been increasing as well, and nearly 5 billion returned to shareholder in just 3 months. When evaluating stocks, consistent capital returns like this is a major positive because it directly boosts per share value. So for valuation purposes, Visa's cash flow story is a textbook perfect. High conversion, efficient capital allocation, and shareholder friendly returns. This is exactly the kind of cash flow profile that justifies premium valuation multiples. So now let's go through our valuation models. So let's start with the CAP parameters that drives our discount rates. Using our current market conditions, these fuels pulls data from this Federal Reserve Bank, or known as Fed. So this is where it's getting the risk percent and some of the terminal growth rate as well. And however, the beta for this one is at 0.7, and I'm going to be using a 5-year projection. So let's enable economic cycle analysis, which basically, as I mentioned, uses data from Federal Reserve Bank. And another thing we're going to be looking at or enabling is behavior financial analysts. So these are some of the assumptions that I believe to be true. So for low case, we're going to assume low case, which is in this case bear case scenario. We're going to assume increased regulatory pressure, slow cash to card migration, and stablecoin disruption impacting growth. This leads to lower margin growth, profit margin, free cash flow, and a few other metrics. And mid case RB, our base case scenario, where I believe most likely scenario, steady execution per management's guidance. And I believe if everything stays the same, then these are the normal case. In our bull case scenario, we're gonna assume the accelerated growth, digital payment adoption, successful expansion of value-added services, and continued operating leverages. So these are some of the bull case scenarios. And after I run our valuation model, so you can see that if you believe in the low assumptions, then the stock is worth around $226, and if you believe in high, then it's worth $119. And from our mid scenario case, it's worth $229. And if you're looking at P valuation range, then it's worth $249 or $349 for high. And these are just honestly my assumptions based on my research. And what's crucial to understand that even in bear case, Visa isn't cheap, and it still is quite expensive. So look through our growth rate and discount rate. It is still significantly needs to come down 33%, which is quite a lot. And if you're looking at a growth rate of 18 and discount rate of 8.5, then it is at fair value, and that goes for 13.2% as well. So I believe overall, and these are just data that I pulled from Federal Reserves. And this is also model that I created, which is called behavioral analysis model. These are the assumptions that I made. Based on that, it tells me that my assumptions appears to be optimistic relative to historical and peer benchmark. And I'm being very overly confident. So it doesn't look good because it needs to fairly come down. I believe it's worth around $229, and based on that, it needs to come down at least 33%. So the final takeaway is that will I be buying this stock whenever it becomes undervalued? To wrap this up, I would like to highlight some important takeaway. The real magic of Visa's growth story is how these drivers combine to a self-reinforcing virtuous cycle. It starts with more payment flows attracting more participants to network, more banks issuing Visa cards, more merchants accepting them, more fintech building on their infrastructure. This increased activity generates more data, which Visa uses to enhance their fraud detection algorithms and analytic capabilities. Better fraud protection makes the network more secure, while superior data analytics provide valuable insights to financial institutions and merchants. These improved services make the entire Visa platform more valuable to all participants, which attracts even more users and transactions, starting this cycle anew. It's this compounding effect that makes Visa's growth so sustainable and incredibly difficult for competitors to disturb. Visa operates one of the best business models in corporate America, a global payment network with a powerful network effects. And you saw this in Visa's financials. They have strong revenue. They've been buying back their shares quite a lot, and their EPS been growing at an astounding rate. So long-term growth drivers remain robust with global shift from cash to cards, increasing digital payment adoption and expansion to higher margin value-added services. And Visa's 26% growth in value-added services shows this strategy is already paying off. However, the premium valuation is hard to ignore. Bottom line, Visa is a phenomenal business, but today's price is not a compelling buy for me. Honestly, overall, my opinion is it's a bit expensive right now, and if it becomes fairly valued, then I will be more than happy to buy it. Overall, this is it for today. Thank you for joining me for this deep value into Visa, and see you in the next video. Until then, happy investing, and thank you for sticking with me till the end. Bye.